Good day. It's noon on Tuesday, June the 2nd. This is Joe Gordon with Gordon Asset Management for our weekly update on what's going on in the markets in this post-pandemic world, or at least we hope it's post-pandemic. As usual, we have to put up our disclosure. We're not really giving investment advice or advice of any kind. These are simply our thoughts and using some great material provided by some of our financial institution partners. Nonetheless, it is a required disclosure. So you can sign up for updates at our website, wealthqb.com, and you know the consistent thesis or opinions that we have had about this are we in the bull market or is it dead? And there is a hot debate on that, and a new acronym everyone keeps mentioning too. It's in the media all over the place: FOMO, fear of missing out. So let's see what happened last week. For the second straight week, the market was up over 3%. That would definitely feed into the folks that have been more conservative and on the sidelines. We'll get into that. But rising global optimism, and even in the wake of the controversy around the death of George Floyd. So things like the market didn't really care. So anyway, you can see there the S&P level at 3,060, down from a high up here and about 3,400 or so rounding. But the point is that the rebound off the sharp bottom has really been kind of a V-shaped rebound in the market. People are hoping that it follows, that there's a V-shaped recovery in the economy. So moving ahead, let's look at what's going on the sector. This is data updated by JP Morgan that we look at every quarter pretty hard. We just learned it's actually updated even daily, which is quite a task to do. But if you look at sectors in the S&P 500, and this is through May 31st, so it's very fresh, you can see energy is now only 2.9% of the index, and that's because it's a market cap weighted index, and energy's been the worst asset class. It has rebounded, though, 32% in the quarter that we're in, that began April the 1st, after hitting a bottom in early April, but still as a sector is still down 34% year to date. Financials, pretty much the same story, rebounded 12 to 13% in the quarter so far, but still down 23% year to date. And so on. If you look at the other side of things, you can see technology up 22% in the quarter to date, bringing it to a positive return year to date at over 7%. Consumer staples, or communication services, up 21% and flat year to date. And then if you go over to real estate, real estate got crushed pretty hard with the downdraft in the market beginning in late March. It is rebounded. It had a really good week, up 4 to 5% last week, which is good, bringing its quarter-to-date return at just shy of 12%. It seemed really strange that real estate was so oversold, given that we have zero interest rates. A lot of that was the fear that there would be a huge collapse in people paying rent, both individually and commercially. Healthcare has been solid, up 16% quarter to date, positive for the year, etc. About every sector you can see here is doing really well this quarter. Probably utilities, again, like real estate, have been a laggard in this quarter, but not down so bad year to date at minus 6.8. So overall, this is hope, or things to be happy about. But if you go down here towards the bottom, one of the things that is eye-opening is when you look at next 12 months earnings growth by sector, and you look at 20-year average. So there's no growth projected at all in energy, in fact, minus 78%. If you go over to technology, you see earnings growth positive, and the 20-year average is still half of that. And if you go to healthcare, it's kind of similar. Projected earnings growth 4.7% next 12 months, but the 20-year average is at 9.4%. So overall, there is a snapback going on, but we'll see if it's anywhere as strong as the long-term averages. Another way to look at all the data is in the Morningstar style box kind of framework, and we don't really adhere to this all that much, except as a way to have a conversation. But when you look at what's going on, it's really easy to see that we've been in a growth-led market. Not only quarter to date is growth doing much better than value, at least value is positive, but even if year to date growth is positive, value is still down 15%. And again, value and large value is dominated by materials and energy and financials, which have been the worst sectors more or less. But the story is pretty much the same when you look at growth, whether it's small cap or large cap companies versus the value small and mids as well. So it's still a momentum growth market. We have clients asking us about all these names they read about that are tech companies that are up 40%, 50%, and say, yeah, they're trading at 15 times sales or 70 times sales or 100 times earnings. And you know, it's crazy valuations, but that's what happens when the market goes totally all in on momentum stocks. If you look at market lows since 2009, since that was the last end of the secular bear market, you can see growth has dominated, up 622% over value, 344%. And you can see it doesn't matter whether it's mid cap or small caps, it's the same story, just different numbers. Growth has crushed value. And a lot of people are capitulating on value investing, again, because of that very reason. So looking at valuation, so you can see back here when the tech bubble burst in 99-2000, we had S&P index forward PE ratios north of 24 times earnings, and now you can see we've snapped back a great bit, and we're up to, you know, basically around a 22 times, just under 22 times forward PE ratio. So it has been a rally. It's based on momentum and hope. It's obviously, we got to see the economy come and support that going forward. If you look at the dividend yield on the S&P 500, it's just under 2%. And again, we don't have this slide today, but 5 big tech stocks do push these valuation levels up significantly for the other 495 stocks in the index. So look at earnings growth estimates. This is kind of insightful. If you look at the top chart, you see these were year-over-year percentage change estimates in S&P earnings growth in 2019. See here as of 12/31. So it's 12/31 on the far right. Energy was projected at 20% growth, and now the estimate's minus 106 as of May 31. So you can see how things can really change on a dime when you have the world shut down, which has never happened before. Obviously, energy was the worst sector by far, but even estimates on consumer discretionary down 54% versus a predicted 12 at the end of 2019. Industrials down 46%, financials 36%. So with everything shutting down, obviously, all the estimates have changed as well, and many don't look good. The good news is over in utilities and technology, consumer staples. Again, staples, think grocery stores, CVS, Walgreens, Costco, those kinds of things, Walmart and Kroger, etc. Getting a little ahead of myself here on the slides. Switching back over as we've looked at coronavirus issues and so forth, as you can see here, the tall left bar, the number of cases, we're just at under 1.8 million in the U.S. as of May 31. A little bit over 104,000 fatalities as of May 31st. And then you can come over here and kind of see the graph, which is change in confirmed cases and fatalities. Fatalities is the gray line, confirmed cases, the light blue line. And you can see it has kind of flatlined beginning at the end of March and has been slowly going down and cresting. But most everyone on this call or who is going to watch the replay knows that one of the interesting things of all the looting and rioting going on over the weekend is there was no social distancing being practiced whatsoever. And so you have to wonder if there's going to be a tremendous spike, especially in large cities where the rioting was the most significant with the number of people turning out. Unemployment, let's look at this for a second. Through May 31st, consumer spending by industry, you can see that of our GDP, which is about 20 trillion, a little over 4 trillion is in the hospitality industry, entertainment, restaurants, bars, travel, hotel, etc. And you can see that's a large part of it, but that's also been the hardest hit. So literally 30 million Americans, 31 million out of employed there, 20% of all payroll jobs. And of course, that's been ground zero for the hardest hit. If you look at the middle, you can see who's been hit the hardest in unemployment is clearly those that are less educated. If you have a college degree or greater, the unemployment rate's only 8.4%. If you have no or less than a high school degree, it's 21%. If you have high school degree, no college, it's 17%. And then you can see it over here graphed by earnings. If you have an advanced degree and so forth, obviously you have the highest earnings. And then if you're a high school graduate, you're at the lower level at 39,000 versus 100,000. And then again, bachelor's degree, 71,000 in the middle. So unemployment and wages. This is where the disconnect comes. How does personal income soar 10.5% when 20 million jobs are lost in April? It's easy. And obviously someone else replaced it, the Fed. So you can see here for every dollar lost in April, the government stepped in with more than $4 of stimulus to the unemployed. And I think that stimulus includes the Paycheck Protection Program. So that is the big disconnect. It's really that the market's been propped up not so much by hope, but by Fed stimulus. And at some point, that will stop. And that's the biggest concern. You can see here unemployment rate and year-over-year wage growth for private production and non-supervisory workers through a 50-year average. And so you can see it and so forth. And unemployment rate, but now the unemployment rate, a little bit black by my screen, is spiked up to the all-time highest levels. And so we'll see what wage growth looks like going forward there. So inflation or lack thereof, basically, we've seen some food inflation. There's some supply chain issues. A lot of us have heard about chicken shortages, beef shortages, and the like. Obviously, toilet paper shortages. That was the predominant theme in March. But when you really look at it and you look at consumer prices and core CPI, there really isn't any out there. And so one of the things the Fed has wanted to do, and they say their band-aid of 2% inflation, is to stir it up and have a higher growth economy. But right now, that's not the case. And so there could be inflation in the future, could be high taxes to go with it. We'll see. But right now, it's just not in there at all. So looking around the world, there are some countries that have entered deflation. You can see here graphed with Korea, South Korea, basically their economy deflated. And again, they had a partial shutdown, probably one of the countries that has deemed it managed it the best as far as flatlining and eliminating new cases and deaths. But generally, stocks don't do well in deflationary environments. And so we'll just have to see again, what does all the stimulus do when it fades and wears off? And then if you look at other things, we've got these new social and political risks with all the violence going on overnight in major New York cities and even minor cities. I mean, it's everywhere, the protesting and the fact that nobody was adhering to social distancing and so forth. We'll see what the fallout is. And there are National Guard troops, I know, in D.C. I don't know where else they are. I think some have even been called out in North Carolina, and we're in Raleigh because of the looting and the rioting of a couple nights ago. But obviously, there's a whole new story hogging the media headlines, and the only positive thing you could really say is that it has sort of taken away any concern about the coronavirus. So here's an interesting data point is if you look at those who rate the national economic conditions as excellent or good, clearly with COVID-19, you would expect things would fall off a cliff, just like our stock market did and the economy shut down. So Republican or leaning Republican in the red has gone from a high rating of almost 80% pretty pleased to down to 37. You can see the total in the gray is 23 from a high of 52 or 3%. And then clearly Democrat or lean Democrat has gone from pretty much a high of 28 or so percent down to 11, and that's certainly not surprising. Okay, diversification. Well, here we go again, looking at a graph of those who want to be in all stocks, fear of missing out, to those who probably should be in a 60-40 stock bond portfolio based on age and risk temperament, or even less aggressive, a 40-60 stock bond allocation. And you can see over time that they graph essentially the same. In secular bull markets like we've had since 2009, clearly all stocks has gotten way ahead. And then clearly you can see in this graph, stocks falling a good bit too in 2020 with the onslaught of the pandemic. And so if you stay invested and stay diversified, again, you can smooth out returns long term. And here, if you look at 20-year returns by asset class, this is one reason why you see the best returns are in REITs. We say that tell our clients that most should have somewhere around 5 to 15%, call it 10% in the middle in real estate related investments. But you see also over 20 years in this time period that gold has done better than the S&P 500. And you can see the returns with much less volatility of the 60-40, 40-60 at 5.6 and 5.4% annualized respectively versus just 6.1 for the S&P because you take all the downside risk. The orange one's the most telling. For those that chase hot returns, generally only buying after things have run up significantly, average investors average 2.5%. Okay, so this is basically saying the same thing, time diversification and volatility. If you look at volatility on a 1-year basis, obviously stocks are the riskiest on the downside. You can potentially lose 39%, but you also can make 47%. If you look at annual total returns through a 70-year time period. And then if you look at some kind of bond portfolio, much less volatility to the downside, and then up to 43% in a snapback year like 2009 after the financial crisis. And then basically a 50-50 stock bond portfolio. So clearly 1 year you have a lot of volatility, but over time you can see that you see a smoothing effect of returns. But that doesn't mean that if you have a 20-year rolling return that you don't have downside volatility. In any 1-year period, you do, and that's graphed over here. So that's it for today. Again, the theme really update, fear of missing out, 2 good back-to-back weeks in the stock market. For those that want to discuss their specific asset allocation, we're happy to take those calls, Glenn Moore or myself, Joe Gordon. And we look forward to reporting back in the next week, and hopefully the news will continue to improve. Thank you.